Here's a hot take. It doesn't matter if the feds cut rates. Mortgage rates can still come down. Now you're probably saying, what the frick, Hills? That's all anybody's been talking about, including you. And you'd be right, but let me explain. A bit of a hot take for sure, since everyone and their mother has been waiting on bated breath for the feds to drop rates, including yours truly. But last Friday reminded us of a lesson we've learned many times before. Heck, we shot several shows on this topic over the past decade and a half. What is the lesson that we have since forgotten? It's simply this. The Fed's fund rate does not have a direct impact on mortgage rates. Indirect, yes, but not directly. Heck, let's take a look at much younger Ryan there, who looks oddly like 45-year-old Ryan, poor guy. He went gray when he was 28. He's like Benjamin Button, but instead of reverse aging, he's been like 45 years old for the past 15 years. Poor little guy. Anyways, what younger Ryan was explaining is what we learned in all the other rate hiking and lowering cycles is oftentimes mortgage rates can and will have an inverse relationship with Fed moves. Like in the example I'm talking about here previously. The Feds hiked rates a quarter point that day, but mortgage rates actually dropped. We've shot many shows on this topic over the years explaining this, but we may have forgotten this, and for good reason. Let's be honest and be real. In general, all of the markets and industries would love for the Feds to reverse course and lower rates. That part's true, right? But again, Friday reminded us that we don't necessarily have to wait for the Feds to do that before rates come down. On Friday, job growth was much lower than expected and mortgage-backed securities rallied. Opened the day up 40 basis points and mortgage rates improved. See, that's my point about the Fed rate cut not really mattering. Yes, in general, we need to tame inflation and then finally lower mortgage rates. And the Fed fund rate. It's a big deal and it's hurting a lot of Americans right now. But let's not forget that the mortgage rates can and will come down without that decision. Heck guys, let's also not forget the QE lever either. The Feds could and have previously purchased mortgage-backed securities to put downward pressure on just mortgage rates many times before. They theoretically can go this route again as well. Honestly, don't think they want to go this route, but again, it is an option and it is possible. But overall, team, this is a good reminder that we don't necessarily have to wait for the Feds to cut rates to see a rate improvement. For fun, let's go back in time and see younger Ryan explain this, and this is a pretty cool and great reminder to content creators about evergreen content not going out of style. We can go back in time 7 to 8 years and leverage some evergreen content to hammer down today's point. Let's do that and play at 1.5 speed for the sake of time.
So the Fed raised rates a quarter of a point. Why didn't mortgage rates increase? That's a great question. First things first. The Fed raised the federal funds rate a quarter of a point. Key word being the federal funds rate, not mortgage rates. The Fed fund rates being increased affects short-term rates like car loans and credit cards and the prime rate, but not your FHA or VA or conventional 30-year mortgage rate. Matter of fact, the day that the Fed raised the fund rates a quarter of a point, long-term mortgage rates improved slightly. So the media and other ill-informed sources will tell you that mortgage rates went from, say, 4% to 4.25% because the Fed raised rates a quarter point. Not true. Actually, on that day, rates improved slightly for an entirely different reason. Again, not much, but they did improve. Key point is they didn't increase a quarter of a point, like the media said. For example, mortgage rates didn't really move a whole lot on that day, as I said, but if you were paying, say, a point to obtain a 4% mortgage, now it costs, say, only a half a point. So rates didn't go up, as the media said, and they didn't really improve a whole lot, but the cost of obtaining that rate improved. I hope that makes sense. Key point is, mortgage rates did increase because the Fed doesn't control mortgage rates, just the Fed funds rate. So who does control mortgage rates, right? Great question. It's a common belief that the Federal Reserve makes consumer mortgage rates. It doesn't. The Fed doesn't make mortgage rates. Mortgage rates are controlled by mortgage-backed securities, which are controlled by, oddly enough, you and I and Wall Street and other investors, basically people investing into mortgage-backed securities. But the Federal Reserve has no direct connection to the U.S. mortgage rates whatsoever. Indirect, yes, but not direct. Now, what does that mean, Ryan? Well, the Fed does exert an influence on today's mortgage rates, and after its scheduled meetings, the Fed committee issues a press release to the public, which highlights the group's economic opinions and consensus. When the Fed committee's post-meeting release is positive on the U.S. economy, mortgage rates tend to rise. Conversely, when the Fed is generally negative with its outlook, mortgage rates tend to fall. Lately, the Fed has shown a mix of positive and negative. But here's where it gets really strange if I haven't lost you already. We now know the Fed raising the federal funds rate doesn't affect mortgage rates, right? But I did say the Fed indirectly affects mortgage rates, and we kind of know why now as well, right? With their positive and negative comments. So what happened last week that helped mortgage rates? Well, oddly enough, the devil's in the details. Janet Yellen was talking post the rate hike and talking about the economy. Now, the mortgage-backed security market was waiting to hear her address the Fed's future policy in regarding to buying mortgage-backed securities. Yes, the Fed actually does buy billions of dollars worth of mortgage-backed securities. It's honestly the only reason why rates have stayed low, and we've covered this as well in previous shows. What the market wanted to know is the Fed going to continue to buy mortgage-backed securities, and in effect keeping downward pressure on mortgage rates?
Thank you to younger, older Ryan. What a great reminder and a fun trip down memory lane. We still want to see the Fed's fund rate come down, but we'll enjoy these small little mortgage rate improvements until then. Share this with a colleague and a friend today and remind them of this as well, and we'll see you guys next week.